Hey, we're back. We're live, and it's good to see you guys again. First of all, thank you for tuning in, and I just want to commend everybody who jumps on a live call like this to continue to hone their skills and master their craft, and welcome anyone and everyone who's excited about real estate investing, commercial real estate investing specifically. We're going to be diving back into that today with a second round with my buddy, J. Scott Scheel. Hey, RJ, good to see you here. In fact, that's a great idea. If you guys are joining us live right now, definitely say hello in the comments. We're gonna make this more of an interactive one than last time. And so I wanna welcome everyone to go ahead and submit a question, any question that you want about commercial real estate investing, whether it's active investing, passive investing, different types of asset classes. We're going to be talking about action items over the next 3 to 6 months that everyone can be thinking about. And there's no dumb questions, right? If you're a new investor or you're a seasoned investor, I think there's something here for everybody. And I'd encourage you to use the comment section as an opportunity to do some networking, because chances are people listening here, both live and to the replay, are curious about commercial real estate, or they're active investors, or they're brokers. So introduce yourself, say hello, tell people where you're at, tell people what you do, tell people what you're looking for. And what we'll try and do is get to as many questions as we can in the time that we have allotted. In about an hour, we are going to switch over to Clubhouse, so there's even more interactivity available there. Paul, what's up? Good to see you. Evan, hey, good to see you, my man. So do that. And then if you guys are joining and you missed last week's call, you can go back and watch that on demand. So we went through some of the biggest opportunities for 2021, some of the pitfalls to watch out for, some specific action items. Scott talked about his favorite food groups. I think hospitality and retail were crowd favorites. And then we jumped over to Clubhouse and we were talking about some of the most effective ways to source distressed deals. And so we got through 3 of those. We talked about REO, bank-owned property. We talked about using auction platforms. And then probably the number one, and this is certainly for me personally, was broker deal flow. So forging relationships with brokers where they can bring us, pocket listings in some cases, or listed properties that they know or have an inside track of information on. So today, I made the topic kind of broad so that you guys could ask whatever you want about whatever you want. We're going to go through finding, funding, and fixing properties. Scott and I, really because of what he has rubbed off on me, both have a big affinity for fixer-uppers, value-add deals. And I personally think that that's just a great way to help to mitigate risk. And, in a time that's kind of tumultuous, if we're buying at a deep discount and we have the ability to force appreciation, it can cover up for deals that don't go absolutely perfect. So I want to give you guys the opportunity to go ahead and dive in here with some questions. So Evan, you had one last week that we didn't get to. If you want to go ahead and re-prompt us with that, we can bring it up. RJ, I know you've always got some questions. Eric, good to see you here again. What I'll do is I'll just walk through a couple of things that I think about when it comes to finding deals. Scott last week talked about brokers, auctions, and REO. And one of the topics that came up when I asked a dozen or so commercial real estate brokers about how they're sourcing their deals was the concept of omnipresence. So that's the idea of having multiple lines in the water at any given time. So we thought a lot about our online presence. Do you like what you see when someone Googles your name and your company name and what pops up? Is it a good representation? Does it tell brokers who you are and what you're looking for? We talked about direct mail. We talked a lot about social media now. So putting out more and more video content like you guys are seeing us do here. And I really like the concept of it being evergreen. So as you develop it once, it can live over and over and over again and get to the point where you're able to tap back into that catalog of stuff that you've built. So I'll give you a specific example. I've put together a couple of videos on my buying criteria that I can now send to brokers on demand, right? Or if someone reaches out on LinkedIn and they're getting to know me for the first time. It's like, hey, go over, check out this video. It tells you exactly what I'm looking for in the exact market, the exact size, the exact price, the exact asset class. I talk about, the radius to the airport, price per foot, the amount of vacancy that's important to me. And so they can reference that. But within that video, I'm also showcasing some of the deals that I've done that kind of have some credibility. So the last one looked like this. The one before that looked like this. The one before that looked like this. And so they're seeing, okay, I'm getting a better, more clear sense of who this investor is, what they buy, their track record. And then they can turn around to their sellers and say, hey, this guy is a known closer in this market for this asset class. All right, so got a question coming in here from Aaron. What opportunities are available with big box gyms and large theaters being vacant now? Great question, Aaron. It might be a little early still because I think some of that is being worked out as we speak. Certainly in any big spaces, we can look at demising those into smaller suites. So I'll give you an example. When I lost that Snap Fitness down in our Tucson shopping center, that's a 4,500 box, and I wouldn't consider that a large box necessarily, but we could chop that up and do a 2,000-foot suite and another 1,100-foot suite and probably have more users in those smaller sizes and footprints than the big ones. In terms of the theaters, those are definitely going to be a little bit trickier because the unique build out in there, I think Scott had been working on one in his backyard in Ohio where he had done just that. So maybe later on he can chime in with it. All right, got another good question here from RJ. Actually, I can bring these up. I forgot. Can you discuss a little bit about the timing of when to buy properties given the current climate in a post-COVID world? What indicators should we be looking at? What property sizes, types, criteria driving the purchase? Okay, so great question here, RJ. I know last year, I spent much of the year sitting on the sidelines. I sold the deal, fortunately, in early January, and then really didn't buy anything till Christmas Eve. So I kind of hit the pause, wait and see. I was concerned about, catching the falling knife, if you will, and just I also noticed that lenders, particularly in retail, weren't really excited to lend. So credit tightened up, became a lot harder. What I will say is that it gave me the opportunity to go after some seller financing. And I had found that sellers were a lot more receptive than previously to carrying paper, especially for a short period of time. So I'll give you a specific example. I had closed the deal where we offered 5% interest-only financing. Seller carried it for 2 years. And then at the end of that 2-year period, I had the option to extend, but I think by then we'll have leased up some of the vacancy, increased the value, and then had the ability to refinance, take him out. And so that 2-year commitment, I think, felt reasonable to him. I think it leaves me plenty of time to get the assignment completed, get the spaces leased up, and then add value to that property. And I've subsequently had 2 more offers, almost identical in structure, accepted because I think sellers recognize that, a lot of traditional lenders aren't going to lend on a 50% or 60% occupied building. They're making 5, 6, 7% on their money. It's secured against an asset that they know very well, right, as their collateral. So worst case scenario is they're taking back a property that they already know, that I've probably added value to, that I've probably done parking lot improvements, sign improvements, maybe roof improvements, new HVAC, invested in tenant improvement allowance. And so I think that's an unlikely thing to happen, but I think that gives them some certainty. So let's see. In terms of sizes, types, and criteria, that's going to be pretty unique to an individual investor's profile. I think, kind of related to Aaron's questions earlier, I don't love the idea of buying big boxes or theaters right now because they're challenging to backfill and there's very few users that could use those spaces. Personal preference. So great question there. All right. Let's see. Eric, good to see you here. Welcome, my man. Paul, great to see you as well. Evan, did you want to chime in with your question? I know you had one from last week. I can't remember what it was. So if you want to write that back in, go ahead. All right. Okay, so that's a little bit on finding in terms of, I guess I talked about funding a little bit there too, but I love that structure right now of bringing in seller financing with the acquisition of a property because it's allowing me to stretch my dollar further. So I'll give you an example on this new deal, which I just opened escrow on in Gilbert, Arizona. The seller accepted a 15% down payment. It's going to be about $1 million purchase price, and he's going to carry back a little over $800,000 for 2 years at 6% interest only. So when we're thinking about building that capital stack, I can go in and get that seller financing. In this case, that's going to cover almost 85% of my acquisition and then fill in the gap funding. With a deal of that size, I might just do that one on my own, but on larger deals like that, we can syndicate those and bring in joint venture partners with the help of an attorney, doing a private placement memorandum, things of that nature. But that allows us to buy bigger, higher quality, institutional grade assets in a lot of cases without having to have all the pieces of the puzzle. So my last few deals have been, 3, 4, 5, 6 friends or colleagues that I've had existing relationships with, and they each own their proportional share of the building. So they're benefiting from the cash flow, they're benefiting from the loan pay down, they're benefiting from the appreciation that's baked into the leases, right? We write in 3%, 5% bumps, 2 to 3% bumps in those leases. And they're also getting their proportional share of the tax advantages or the depreciation. So that's one thing that is, I think, fun and unique about commercial and direct ownership versus something like REITs or rental properties, single family, where you don't have quite as much money to go around and an extra comma and more zeros, you might say. And then let's see here. So fixing the property. So in the asset class that I focus on, which is commercial and retail specifically, what I tend to do is buy buildings with high vacancy. So this last deal was 66% vacant. It had been that way for a while, and the previous owner was not reinvesting into the parking lot. He had a pretty tired looking sign. I don't think he was big on tenant improvement allowance. And so when I go in and do those things, that's going to help us to attract new tenants to the property and get that vacancy filled up, which is going to increase the net operating income of a building. So as that net operating income goes up, there's a pretty tight, almost direct correlation to value of the building increasing. Similarly, you go to the other side and you can tighten up the expenses or maybe get better triple nets or common area maintenance costs. That could attract the tenant to come over to our center where they might not otherwise consider that, because across the street, triple nets are running $5. Here, they're able to get them to $2, and that might be a more attractive lease. So good question. All right, and then Evan, I've got your question here on deck too. Oh, and we've got Scott tuning in here. So let's see if Scott, if I can add you to the stream. All right. Hey.
Hey, brother. So sorry. I mean, literally swapped out computers. It was a disaster. Look, I don't think anybody who knows me or knows anything about what we're doing here understands that technically in 2021, I'm a little challenged, but my system completely let me down. So sorry to leave you, basically running the, keeping the ship afloat on your own. But it's great to be here with you, brother. And, happy to dive right in and, start shouldering a little bit of the load. Certainly missed everybody, and thanks for tuning in.
Let's do it. So I queued everyone up that I was encouraging questions and answer the whole time. So I started tackling a couple questions here and reminded people that they could go back and check out last week's live stream and some of the stuff that we covered, not just on LinkedIn, but also on Clubhouse. So Scott, I think you'll be able to see some of the comments as they're coming in live here. But you and I had also talked a little bit. In fact, as of 10 minutes ago, there's some new stimulus news, right? $1.9 trillion just got greenlit. So I think that'd be an interesting thing to kick off with. And thinking about what does that mean for us as real estate investors, specifically commercial real estate investors? Is there any impact on, us steering the ship in a different direction that, you're personally thinking about, implications in that?
Yeah, no, there's no doubt about it. I think the $1.9 trillion stimulus package it's a bit of a red herring. I've read a significant portion of it, and probably by the end of the week, I'll have ground all the way through the 540 pages of legislation. And the reality of it is that it's probably a little more of a drag than people would want to believe. Now, no matter what happens, when you're putting $1.9 trillion into an economy, that's an incredible amount of impact and revenue that's going to come through. And whether people believe it's special interest or whether people believe it's their pet projects or whatever, it's still going to get spent. And the reality of it is that it's going to get spent over the course of the next probably closer to 5 to 10 years. A significant portion, close to half of it, doesn't even get released until 2023. It's not necessarily immediate stimulus, but what it is going to do is it's going to put money back in the hands of people who are kind of hurt by the pandemic, but it's not going to forestall all of the legislative defaults that are coming. So when you deal with banks that have kind of been playing nice, there really isn't any guidance to protect business owners, homeowners, mortgagees, people who have student loans, that type of debt. And there's still going to be that big fallout. But when you couple the stimulus with the pent-up demand that people just have for wanting to get out of their house and get back and starting to be social again, it is kind of coming at the right time. And you're starting to see various states, really opening up. So, we're even feeling it with our live event that's going to be coming up in Orlando. There's a lot more people willing to travel. There's still plenty. The overwhelming majority are still not traveling. Mm-hmm. But we're really starting to see it. So, the stimulus package in the long term, I think is going to be probably damaging on our economy and to our currency. But in the short term, I do think that the money is going to get into the hands of people. It's going to get into the hands of government. And I think they're going to unleash some of the infrastructure projects that have been on hold for a little while. So, overall, if I had to give it, a 1 out of 10, what it's going to do for us, I kind of see it as probably about a 6.5 to a 7, meaning that it's going to be a boost. It's going to be a little bit of wind at your back. But ultimately, is it going to really support our broader ambitions? Not really. I think we're going to be in some real trouble still.
Okay, well, so that's a good segue to one other item that you and I talked about. Lockdowns easing up a little bit, and what are the implications? For you, me, and anyone else investing, business owners, brokers, all the commercial real estate professionals out there. Is there any action items or implications from that standpoint?
Well, there's a ton. I think the idea, though, is taking a look at which tenants are going to be viable. There's a ton of categories that were superheated heading into, governmental lockdowns and all of that. So let's talk about, your restaurants and your gyms. We can talk about your entertainment venues. Those were exploding, right? Recreational facilities, hospitality. There's a fair amount of the stimulus that's going to go back and try to bolster those businesses. So, if they've been able to survive up until this point, the guidance from me as a landlord is it's a hell of a lot easier to try and stabilize the ship that you're in than it is to swim to a new vessel, right? So, yeah, you took on water, yeah, maybe even capsized, but you know what? If you've got the ship righted, you're better off riding, the folks that fought hard through some of the worst crises that we could imagine as far as a landlord to kind of keep them going and stimulate them. So if it means, a further, let's say, negotiation towards reducing rent or giving them a little bit of forbearance or, working something out with your senior lender to keep somebody there, it's gonna be a lot cheaper to keep her than it is to go ahead and try and replace it. So that's a big part of it. The other part of it is to say that the Biden-Harris administration has recently implemented a couple of, kind of cool tactics that should stimulate those industries, right? So if you're a fitness or a gym facility, there are some that are saying some of the, kind of preventative healthcare measures that are being promoted by this package are really going to help people, try and get back out there and do things to manage their own wellness, as opposed to looking for a solution after wellness has gone away, which has been in large part what's happened with COVID. And then when it comes to the restaurants, they reinstituted, I guess an old policy, something that was going on back at the late 90s, early 2000s, where literally 100% of your business meals are now deductible.
Mm.
And that hasn't been the case for a while, ladies and gentlemen. So, instead of, hey, let's do a Zoom call, let's get a free meal on Uncle Sam, right? That used to be old philosophy. Hey, let's go have a nice meal. Let's get some stuff going. As a stimulator to your restaurants, they're kind of baiting us with that 35%, surcharge that we're able to keep because we're not paying that tax. So those are going to be some things I think they're going to help. I know that a lot of people are stir crazy. And, just kind of as the lockdowns were happening coming out of winter, looks like the reopening and the reemergence with the vaccines and the easing of social distancing are releasing people right when we're getting that break in the weather. So I think there's going to be a tremendous amount of pent-up energy. I think a lot of the stimulus money that's been that's been allocated, that's going to be getting into people's hands, it's going to get spent really quickly, not necessarily on catching up on bills and obligations and responsibilities, but much more so on just, holy shit, we're out, we're free, let's go spending like sailors on leave. So I think you're going to see a tremendous amount of that happening.
Okay, semi-related question here. Aaron asked earlier about big box gyms and large theaters. Is there an opportunity or a play there? And I think you had a theater in portfolio, right, at Willoughby. So do you want to comment or give any ideas on that?
Yeah, so I think right now for theaters, there's certainly opportunity for adaptive reuse. It depends on the size of the theater, whether it's standalone, whether it's inline, whether it's in a shopping mall. All of those things are going to have major implications as to what you're looking to do. But make no mistake about it, there's a lot of chains that are going away. They're not coming back. Hollywood has rolled out a new distribution model. So their new distribution model is called Day and Date, which means that we're gonna open Wonder Woman 84, and you can see it in theaters, whichever ones are open, but you can also begin streaming it now on HBO Max or Netflix or whatever company sponsored the production. And that's likely to continue. However, I was literally having this debate this morning because I'm negotiating to reopen this theater and get that all dialed in. And, we're out there picking up, very gently used high-end digital projection equipment, right? $150,000 per projector. And, at least initial indications are that we're gonna be able to pick these things up in the $5,000 to $7,000 per range. There are still plenty of people, such as myself, I'm old school, who love that theater experience. There's just something about watching a scary movie in the dark next to a stranger that takes it to another level, right? So I think there's opportunity. And when you talk about it, what had happened was there was a lot of concentration of theaters, right? You had your AMCs, you had your iPics, you had your, Studio Movie Grills, you've got your, Regal Cinemas, you've got your Cinemarks, right? Those are your bigger guys. A lot of those guys are closing down. And so where you had if you drop a 10-mile to 15-mile radius, because that's about how far, that theater triangle is, and really people will go 20 to 25 miles for a movie theater, you really are consolidating. So even if traffic at theaters is down, I still think if you have a quality theater, there's an opportunity to resurrect that use. Now, adaptive reuse of those things can be easy or it can be difficult because you've got grade changed in the slope floor. So you get that kind of, stadium theater seating sort of arrangement where the guys or gals head in front of you isn't blocking your view. Today, you've got, far less occupancy. And the reason of that is because you're dealing with, large scale, full recliner seats and, leather with, wide things and, much different distance between the seats. than say you saw back in the day. So, are people going to be going out paying 15, 20 bucks for a 2-hour entertainment and 5 people go, or you do it for a family? I don't know. But I think the model still does work there. As far as gyms are concerned, again, it's the same thing. It's consolidation. And a lot of people are pent up. I mean, I got to tell you right now here, things have just started to get warm in the Midwest. For those of you who don't know, I'm in Cleveland, Ohio. And, it's 70 degrees today. So this is one of our first really nice warm days. And I mean, I got to tell you, the people are out in full force. I mean, they're thrilled. I mean, we still have a modest mask mandate, mostly for indoor stuff. And people are literally flying all over the place, and they're dying to get in there and get themselves back into that, professional fitness environment. And because so many chains have died because they were running thin, or because they were kind of the juggernaut, taking old big boxes before, landlords put a ton of money into them, and they really weren't able to dial back the rental figures that they were paying because it got them out of covenant compliance. And a lot of guys just took in their low performing gyms, whether, fitness, and I have a partner of mine who is a consultant to the fitness industry, and they just went ahead and turned over the stuff they didn't want. They just gave it back. And so you're going to see a tremendous amount of that stuff continuing to occur, consolidation in the industry. And I think it's going to be 3 to 5 years before it completely straightens itself out. So if you were in a position to acquire one of those, I wouldn't dive back in to either of those categories wholeheartedly or with big TI dollars on, let's call it future stability in either of those industries. I think they're very much in transition. So adaptive reuse is the first order of business.
Okay. This is semi-related. I saw it pop up. Eric's question here. Speaking of Cleveland, when do you expect multifamily fallout to start? That's interesting. I don't know if that's a guarantee.
Right.
Do you want to comment on that? Maybe more broadly, not just for the Cleveland listeners.
Yeah, no, for sure. Nationwide, I do believe that there's going to be turbulence in the marketplace, whether or not, I'm not sitting here predicting total collapse by any stretch of the imagination. I think there's going to be, still tremendous demand in the multifamily marketplace, but I do think you're going to start to see downward rental pressure. I think there's going to be a lot of people who are going to be, vacating. I think there's a lot of people who are not going to be catching up on defaulted rents. I think there's going to be a lot of evictions that go on, which are going to hamper historic operating statements. And I think those that didn't fare well are going to be punished by their senior lenders. I also think that there's going to be impact in the underlying financial structure of the deals that have recently come to market because there were such thin, operating covenants in their debt coverage ratios. So if you lose, $50 a month in rent on your top tier units, $600 a year is enough to go ahead and tip that debt coverage in a direction where the bank's like, look, we're going after sponsorship. We want this thing gone out of portfolio. So I think that's where the turbulence comes from. When does that begin happening? I believe you're going to start to see it when the courts open up and start hearing cases, right? When the courts allow landlords to evict tenants, right, in accordance with their lease agreements. But I still think you're going to see a ton of tenants that just, kind of leave out thieves in the middle of the night. They're just gone. And you're not going to be able to chase them down. And it's not really worth chasing them for 6 months of COVID rent. You may think it is, but by the time you get that hearing date, you're that far into the legal process. And are they really collectible? Is it worth having a judgment? So, you kind of want to weigh your aggression and your ambitions. But if I were to, say when those things are going to start happening, I would expect the court dockets to start filling up second quarter of this year. And I would expect the resulting decisions that are going to cause that to happen, which is going to impact the operating statements and then alert the lenders who are then going to get their own court date. I think we're third, fourth quarter this year at the earliest, and more likely into 2022 before you start to see people lose their grip on those assets. It doesn't mean they're not in trouble. And it doesn't mean that if you're prospecting them that you're not going to get somebody to look for you to throw them a lifeline. But what I think it does mean is that, before people are, looking at their last resort, we're probably into early 22.
So RJ had a slightly related question. I'll pull it up here in just a second. But in fact, anyone listening live right now, we're going to give you the opportunity to ask a question, and we can kind of dive into it a little bit. So type that into the comments here. And RJ, your question, which I spoke about a little bit, was timing related. So let's see here. Scott, I lost your camera, but do you want to give RJ some thoughts on, it's tricky to like perfectly try and time a deal, right? I don't think you've told anyone to completely stop going out and acquiring, but can we be with timing right now?
Well, look, I think we've got to be, always aware and alert. I mean, I guess the best way for me to say this, and Sean, I think I'm getting some feedback from my team that we're having some trouble with the video feed. Are you seeing that?
It looks a little slow, but your audio's coming through well. So if we want,
all right. So if you'll give me 1 second, and I apologize, we're going to do a quick swap. I think my team's ready to pull that off. So okay, give me 1 second. I'm gonna
give it a ride. And then Paul, I've got your question on deck here. I saw that come in here. So my journey has been on the passive side with rentals and being a LP, so limited partner for anyone not familiar, in commercial property. Excellent. I think that is a great idea, and it's something that I wish I would have done sooner. I plan on focusing on the active side by doing BRRRRs. So if you guys aren't familiar, that's buy, renovate, rent, refinance, and PS. We can do that in commercial too. Very similar model to what Scott and I are big believers in. But considering change that plan to investing in commercial real estate, what guidance would you have for passive investors wanting to be more active? Okay, so great question, Paul. I think you're doing exactly what I would recommend is get experience as an LP. And if you can see the deal from the inside and see how the operator is running it, the reporting, how they're managing their tenants, how they're managing the property, I think those are all great ways to get familiarized. So Scott, you kind of came in and out, but Paul is asking about transitioning from an LP over to more of a GP role. Any thoughts around that transition? Maybe how to make it as smooth or as seamless as possible.
All right. Well, good. This is one where I'm just going to be flat out self-serving on this one. Don't go it alone. Don't try and be a hero. I mean, honestly, you can speak to it. I got tens of thousands of folks that can talk about it as well. Again, I'm not trying to be snarky when I say this. You cannot exist in a vacuum. This is not a one man or one woman type of an arrangement. This is a team. This is an environment. If you really want to do it and be successful at the very highest levels, the best way to do it is to get engaged with people who are going to be around you and support you. The problem with it is that this industry really isn't that industry. It's the type of industry where it's like, look, they want to watch you drown. In fact, when they see you, they're not throwing you a lifeline. They're not giving you a hand. They're actually putting their foot on your forehead and making sure they submerge you. So, as far as the passive side and what you've done up until this point, that's a great way to get in and get familiar. We always encourage folks. And in fact, a lot of the folks that work with us in our mastermind group, our platinum group, our diamond group are there as a passive investor. They're killing it in their regular business and they need the tax shelters. They want those, fixed asset type returns and safety, which right now in my mind is really the place to be. So when you start to switch over, scale, sizing, appropriateness, weighing all of the costs, not just the cost of the asset, but really how long is it going to take you to accomplish your objectives? And what happens if those timelines become extrapolated, right? If you think you're going to get it done in 6 weeks or 6 months, what if it takes you, 2 years to get that done? Because there are always twists, turns, and curveballs that are going to be thrown our way. In addition to that, taking on a project that, really has so much scale and size to it that is really outside of your comfort zone, can seem like you're getting a lot of value on the front end when you're buying cheap. But at the end of the day, people have to recognize commercial real estate is all funded, renovated, leased, and evaluated on a dollars per square foot basis, which means the more square footage you've got, the more it's going to cost you to even get a deal done. Whether it's the broker getting paid on a per square foot basis, whether it is the capital improvements, landlord improvements, tenant improvements. So just start with something that's bite-sized, something that's going to really give you the ability, to get in and execute quickly. We have this model, where, folks get in on something that's 60, 75% occupied, 60%, 50%, but we're talking 20 to 30,000 square feet where one or two tenants tips you over to stabilization. Get those quick wins. Don't sit in the batter's box trying to, hit home runs. It's in the batter's box, try and get on base, right? Hit a couple of singles, make some money, and get out there, put that first 6 or 7 figure check in your pocket, and then you're off to the races. But when when you put something too far out into the distance, or you're overly ambitious, and I'm not telling you to, to downsize your ambitions by any stretch. I'm very passionate about everyone going out there and really crushing it. But if I see people making, one mistake, it's getting in over their head early and not recognizing all of the costs involved in bringing a deal to the pay window.
Paul, I would just add to that too. I think you're doing a great job of being here on a broadcast like this, surrounding yourself with other active real estate investors. And so do exactly what you're doing, right? You're networking here. And I think, you talk to folks who are sponsoring deals, you're just going to pick up and it's going to rub off on you. It's one of the reasons that, I love spending as much time with Scott and the rest of the folks in our mastermind group, is because I'm constantly getting, inspired and excited by what they're doing, seeing how their deals are being structured, sourced, funded, how they're adding value. And, this new deal that I just put under contract this week, I want to present it to them, and we will. That's one of the things we'll be doing together in a few days, where I want, Scott to poke holes in that deal. And I want, other seasoned, members of our group to say, hey, have you thought about this? Have you thought about that? And, sure enough, there's going to be folks in a room like that who can help to shore up any of the, maybe the weaknesses or the inexperience, or the lack of resume or lack of bio, so that, you could start to do some of those on your own if you want to. I've got, Scott, a devil's advocate question to that, though.
Sure.
What about the successful doctor or the attorney or the dentist who's, they got a practice out there and they don't really want to be a deal sponsor. They don't want to go out and pound the pavement and talk to brokers and do direct mail campaigns. They're making a killing, they're ready to write a check, and they just believe in the asset class of commercial real estate, but they've never done a deal before. They've done some rentals, maybe they play in the market, maybe they got some Bitcoin.
Right.
But they see the value in this platform and in this asset class, and they don't really know what to do next.
Right. So what I would tell you is stay in your lane. For the most part, if you're out there and you're crushing it as a physician, or you've got a business that's really, on hyperdrive, generating and throwing off, meaningful cash flow, it doesn't always make a lot of sense to diversify your focus and your resources. But it's a nice thing to go ahead and start becoming familiar with. So again, we have a lot of clients who really are all about just being passive. And, to that end, it's a great thing to earn while you learn and to be involved. Now, you can be on the general partner side and keep yourself out of, let's say, maybe some of harm's way of being an actual sponsor on loans, or having to, work with brokers, or, really even being in first position on capital raise. So those are things that I would say, look, if you get into this business, there's a lot of different levels that you can play the game at. Think of it as, I like to use sports analogies. So think of it as, there's 9 guys on the diamond at one time, right? But only the catcher and the pitcher are involved in every pitch, right? First baseman might sit there for 10 minutes and not catch a ball. He might go through a whole inning without touching something. And for some people, that allows them to do the other things that are important, right? But for us, I think myself, I love being the guy in the mound. I can take advice and guidance from everybody else, but at the end of the day, I'm the one throwing the pitch. right? And if I decide that I see a weakness that nobody else sees, I might even keep it to myself. And the reality of it is that, for those of you who are out there who are largely passive, you want to get that confidence level up, because there's going to be crisis of confidence moments that come, especially if you're a go-it-alone type. As far as being able to get on the general partner side and to lead your own deals, look, that should be the aspiration, I think, for most people here who aren't already crushing it and winning. And I'm talking about seven figures, right? If you're not making seven figures a year, and this is something that elevates you, right? This is that type of a business model that elevates you. And then the tax shelters. I mean, right now it's been left intact. The commercial real estate provide tax shelters that probably outpace almost any other accessible investment to your average bear. Thank God, right? So to me, you've got a lot of reasons to get involved, but one of the biggest ones is you have to keep a lot of your income.
Cool. Okay. So, I mean, Mitchell had a semi-related question there, but I feel like you addressed it reasonably well with Paul. I want to learn about being a landlord and property management. I think, Mitchell, if you could find your way to Orlando, that you're going to learn a ton there with us, because, there's a lot of fundamentals. Scott, do you want to comment on that?
Well, sure. Practical application really is the way, but there are other programs that are available to go ahead and do this. If you want to do it as a professional and you want to do it where you're managing other people's portfolios, then you go ahead and become a, certified property manager, and you can do that at IREM, which is the Institute of Real Estate Management. They're excellent. They've been doing it for many, many decades. And they get you certified so that you can go ahead and obtain a license to manage other people's properties. For us, however, we manage our properties, right? I manage my own stuff. I help, our clients help them manage their properties. And there's a lot to learn. I mean, managing, a retail shopping center is very different than managing, obviously an institutional grade apartment complex, which is very different than managing an industrial property, which is different than managing, construction and development of a housing subdivision. When you talk about, storage units, right? A lot of those are kiosk driven. You don't really even need to really be there. You need, cameras and, a mid-level employee who's going to handle administration, keys, signups, that type of stuff. And I'm not trying to talk down about people who run those things, but not necessarily requiring intense management and a lot of interactions. So when you talk about what you're going to do as far as being a landlord, well, being a landlord, that's great, because you're going to look at everything that you do through probably a triple lens microscope, right? You're going to take a look at the granular detail. You're going to look at the immediate impact, then you're going to look at the broader picture. If you're going to be doing it for somebody else and you're really in the property management side, those things are long-term vision in mind, but really what you're doing is you're trying to streamline operations on a day-to-day basis to pump up net operating income, keep costs down, make sure the property looks good, feels safe, all of those things. So landlording and property management they're kissing cousins, but they're not the same thing. And then when you start to cross across the boundary lines of the different categories of commercial real estate, it really, broadens the discussion, and we could go on for days.
Okay, awesome. Hope that helps, Mitchell. And I see that you're going to be out on Orlando, so look forward to connecting with you there. Again, if you guys are just joining us, feel free to pop in a question. I think this is a great opportunity to network with other commercial real estate professionals. So take advantage, do a little bit of self-promotion in there. Got Joseph here showing you some love. Wants to know your thoughts on the future of the 1031. And Scott, I think a lot of people kind of on the outside have heard 1031 thrown around, but they probably don't know about some of the other strategies that we implement. And so if you want to get into, cost segregations or accelerated depreciation, that could be fascinating.
Yeah. So, it's like Sean's talking, we have not been huge proponents of 1031 exchange. Now, listen, let me back that up. I've been doing this business for 25 years, and I've helped literally hundreds of thousands of folks, by giving them insights into management of portfolio. With that having been said, I am very, very sparsely integrated into 1031 exchange by design. And I don't mind the 1031 exchange. And believe me, ladies and gentlemen, I completely understand that it ups your purchasing power, right? When you save that, capital gains money that you would otherwise pay to the government as their fair share, really what you're doing is you're taking on Uncle Sam as an investment partner, right? It's his money, but he's saying, yeah, you can pay me later. Just go buy a bigger asset. And I have to tell you, other than borrowing from your wife or your mother-in-law, that is the most toxic money on the planet. And it may even be more toxic than mom or, the mother-in-law or mother-in-law or wife. And the reason I say that is because at the end of the day, they want what they've got coming, and they have a lot of say in what you do. And it's not a clear-cut strategy. And every nickel that you have made up until this point has to get reinvested back in the asset. So when it goes back into the asset, it literally means you get no boot, you get no benefit immediately by doing that 1031 exchange, other than buying a larger property. But the challenge there is that you either have to go up or across in leverage, which means you're actually taking on more of the risk, right? The risk is in the debt. The risk isn't in the execution. The risk isn't in the purchase. The risk is in carrying debt that can eventually separate you from an asset that you have just taken all of your hard work, all of your equity, all of your profits and put it into. Because if you lose that asset, you still owe the taxes. That's not a great place to be. And because you got to go up and across in your leverage, it puts a tremendous amount of risk on you. So the future of 1031 exchange right now appears to be viable. It doesn't look like the Biden-Harris administration is going to unwind that immediately. However, I do want you to know that the discussions are out there. And depending on, let's say, how hungry the beast of government gets, they know that it is a Social Security-esque slush fund that they can dip their greedy paws in whenever they need to, because they can make it retroactive. And what happens is they know that you've been putting off paying those taxes in many cases for decades, which means they've got compounding and compounding and compounding. And so when it comes time for them to have that recapture as well as the deferral, in my opinion, it can wipe a lot of folks out. So what do we do to avoid that? Well, there's a lot of things that we do. We stay active in the game. When you buy a property, you always have the ability to go ahead and, instead of using a straight line amortization, 27 and a half years on hybrid commercial, which is multifamily, mobile home parks, residential type, assisted care facilities to a degree, student housing to a degree, anything that's residential or housing related, 27 and a half years of depreciation on a straight line, and 39 years on pure commercial assets. You have the ability to accelerate that property by breaking it down and talking about 5, 7, 10-year, 15-year assets, which, again, if you're talking about a 5-year, that is literally, almost an 8-time stimulator over a 39-year depreciation. So you're front-end loading a lot of that shelter, which can be applied immediately this year against gains that were realized in the prior year or in the year that you're in. So, for me, it is probably one of our better strategies is to create those chunks of depreciation. And I'll tell you this, this is just a little hint as to what's to come. Your ability to attract partnership capital based upon your ability to generate depreciation for folks is one of the greatest, call it, pieces of bait on your lure. It's like, look, it's a great deal. We like the investment. It's going to throw off a 6 or an 8% annualized return, which is stable. It's fixed. It's getting me something better. I'll have an ownership stake in case we're going to sell it. But hey, you mean you can allocate $100,000 in paper loss to me today, that because of the way I've structured my my living arrangements and my professional credentials, I can use that to offset my ordinary income gains? Hey, here's my $100,000, because it's either going into your investment or it's going straight to Uncle Sam, where I really don't get anything back for it, obviously, other than the governmental services. So that's a huge stimulator for a lot of passive investors who want to get in. It's like, well, I can be passive and shelter my tax gains. If you play the game right and you structure it the right way, yes, it can happen, but it isn't an automatic, right? If you're passive, you can't offset active gain with passive losses. So be careful there, but we can certainly help you navigate those waters.
We should probably do the good old disclaimer that we are not CPAs and you want to talk to your tax professional, but we talk to CPAs all day long. So we have a good sense of how this works now.
Here's the reality for me, Sean. Right now, this is free content. Everybody understands, and they should, that we're talking about opinions. These are things that we've done and really experienced. And, you're not necessarily coming to me, and I'm not paying you for advice. You're not paying me for advice. We're just chatting. But the reality is, if you're in my event and you actually sign up for me to train you, you're going to get disclaimered like there's no tomorrow, because I'm not here to act as your attorney. I'm not here to act as your tax planning professional, and I'm certainly not here to be your accountant. But what I do know is what works for most people. But you've got to, as you allude to, Sean, make sure that it's appropriate for your individual situation. And, at the end of the day, it's a moving target. It changes every single year, and you got to stay out in front of it. So, just because you had somebody you liked 5 years ago doesn't mean that they're completely up to snuff on what's going on in 2021 and 2022.
No doubt. Scott, we just have a couple more minutes here till we jump on our next scheduled rendezvous over on Clubhouse.
Well, and hopefully I'll still be there, because I've had every technical challenge you can imagine so far. So again, thanks so much for going ahead and keeping the ship moving in the right direction.
You and I spoke about some action items. I love a good homework assignment action item, like, give the listeners, give the active investors out there a few things to think about and specifically go implement over the next couple weeks leading up to our subsequent meetings or for the rest of this year. And I think last time we did this, you gave, beginning investors a few things to focus on and seasoned investors. And so, if we could cover both of those, I think that'd be fun, because everyone listening could learn and benefit from that.
Well, again, a couple of things I'll tell you right now is that the market is very, very dynamic, and you've got to determine where you're going. If you're chasing everything that comes across your path, it's going to be difficult. So you really have to decide where you're going to invest, where you want to invest, and you got to decide what you want to invest in. Right? I've got folks who are talking to me about hey, Robinhood or Bitcoin, or they want to dive in heavy on the stock market, or they're speculating against energy. Look, you can go anywhere, but you got to know what your objectives are, what your timelines are, and then what you're basically willing to put at risk. It starts there. As soon as you understand the target that you're going for, now we can start to get really specific. And again, we're going to spend, I can't even begin to tell you how many hours focusing on the different categories that are available and the benefits that are going to be available in the next season of our economy in Orlando. We're going to be in Orlando on the 19th through the 21st. For those of you who are interested in that, please get there. But if you're, let's say, somewhat feeling restricted just because, vaccination hasn't really gotten out far enough yet, and you're not feeling at liberty to travel safely, we completely understand that. We get it. So you've got to get educated. And what I mean by getting educated is getting plugged in and connected, because many of the folks who were in this business pre-pandemic are not in the business today. Many of the people who were killing it pre-pandemic are not in there today. So, the concept is always have the capital ready to pull the trigger. That's where I would start. And the best way to do that is to really begin prospecting for folks. If you're a passive investor, raise your hand, let us know. We're happy to talk with you and present different opportunities to you. Obviously, we work with accredited investors, and an accredited investor has recently changed. Those criteria, which had been longstanding and in place since the 1930s, have recently been updated. So if you qualify as that, then you can see, literally hundreds of different opportunities to invest in on an annualized basis. The second thing that I would tell you to do is, if you're going to be an active investor, you cannot steal in slow motion, right? That's just one of those things. So if you find a good opportunity and someone's willing to let it go because you're solving their problem quickly, you've got to be ready to pull the trigger. And I'm going to tell you that bank underwriting is going to be painfully slow over the course of the next 3 to 6 months. Literally, they're going to grind you down to literally almost a halt. And because of that, a lot of your deals are going to go sideways. So the best advice I can give you is, whenever you write a contract right now, you're out there prospecting, you're building your list, you got your private money, you know your targets, you know your asset class, you know the locations you want to work in. you got to change all of your LOIs. We're not doing this stuff like we used to, where brokers, coming up and they're squeezing you like, look, you got to have your offer in. It's 7 days. It's 30 days of due diligence. And, then you're going hard on your earnest money and there's no extensions. And those days that's in the far, far rearview mirror. Today, what we're talking about is maximum flexibility. I mean, we want to give our title company 2 weeks just to give us an updated title report. We want to, give ourselves weeks for surveys. We want to give ourselves months for financing contingencies. We want to make sure that we have a COVID impact clause that allows us to extend our closings. And if our sellers don't want to participate in that, then you're not dealing with a motivated seller. And ladies and gentlemen, there is literally zero reason to deal with an unmotivated seller right now, because the motivated sellers are coming. Now, if you want me to find maybe that one shred of a reason why you might want to consider dealing with an unmotivated seller, it's because, somebody took a hit. They lost a tenant, but they still think they have all the value, or, something's gone wrong somewhere else in their portfolio, and they're just looking at this particular asset. That's one that you highly value and very much covet, and you need to get that asset. Now what you're going to do is you're going to go ahead and play a little more by their rules, because this is a season when you can separate people from previously unattainable assets. So, those are the kind of, two, let's say, two litmus tests that I'm using. Litmus test one is, if it's an unmotivated seller, it better be a Class A asset that I really love in a perfect market that, I would have had to pay 2 cap for if I could even get them to sell it to me pre-pandemic. And today I'm willing to pay market rate for it. And then the other stuff is, if you find somebody who is motivated, we've got to use our creativity. You can't go back to the bank. You've got to have your private capital. And I'm telling you to get in super, super light, right? Let's leave the financing they have in place. Let's negotiate to stabilize that. Let's bring our credibility. Let's bring our team to the table and show that, look, we're shoring up the sponsorship. Yeah, we'll bring some money to the table under the right terms, but we need to stabilize this asset. I'm not jumping on board a sinking ship, hoping that I can bail faster than the water's going to fill.
Could not agree more. And, for anyone out there listening, I mentioned earlier, Scott, I just closed a seller financing deal, the option to extend my term, and I had 2 more offers accepted. I was going to give you an update. We opened escrow just yesterday on a new Arizona deal. So I'll bring you up to speed on that. But great tips, great advice for everyone. So I'm going to personally go back and listen to that one more time when we're all done. We're switching over to Clubhouse in 30 seconds. So I'll see if I can put that link in the chat for you guys here. So you could literally just click over and join us there. Scott, last week on Clubhouse, we did 3 great ways to find deal flow. So I think we can continue that. And Deshaun, I see your question here and your comments. So it looks like we'll have to pick this back up at another time when we have a little more time, but appreciate you guys tuning in. Make sure you're connected to Scott and myself on all the social media platforms, and we'll talk to you in just a few minutes. Scott, thanks for jumping on live.
Hey, thanks, brother. God bless. Peace, everybody. See you soon.